Hello and welcome to this week's episode of Your Financial Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio are two members from Bulman Wealth Group. We have the founder, Chris Bulman, and financial advisor, Scott Bulman. We've got a great show for you today. The title of today's show is How to Detax Your Retirement. Yes, you heard that correctly. Similarly to wanting to detox our lives from harmful substances, we want to detax the taxes out of your retirement. So gentlemen, always fun to be here with you. How are you this week?
Good. It's good to be back. Yeah.
It is good to be back. And Chris this morning was saying how he asked Sean, another advisor, and I, do you have issues shaving? Because Chris said as he's getting older, he's missing patches. And apparently I missed the entire patch because I got some gray stubble. But if you see any like specks of hair.
My face is more like a round ball now, so you just like, it's getting easier.
It's gliding.
There's no sharp turns anymore on the jawline.
He probably doesn't need glasses though because he's squinting a lot. And I do. I need reading glasses now too. I've finally just determined.
I do as well. Yes, it's happening.
I'm holding off on it though.
You know, people ask me sometimes, with those eyes, can you see better in the dark?
Because they're so bright and blue?
Apparently, maybe owls. I don't know. But no, I cannot.
All right, well, back to the subject at hand. We're going to be talking today about how to detax your retirement. And here's the thing. Folks are looking forward to retirement. You want to enjoy the fruits of your hard labor. But what a lot of people don't realize is that they are heading into retirement with a tax hangover. So we're going to use this play on words today, of course, as you want to detox your life from things that are harmful. We want to help you detax your retirement. So first, let me ask you guys this. Why is it that a lot of people are headed into a retirement with a tax hangover and have no idea? What do we mean when we're saying that?
Well, I mean, I would say everyone is taught, we're all taught from the time 401ks were invented and, all the way back to the 80s to defer your income, invest in 401ks, grow your 401k, all these types of things.
Right.
Or maybe you didn't, you had a pension. So you have all these income streams that you're building for later. You're paying yourself, which is the right thing to do. You're paying your future self. So if I'm 30 years old and I'm putting money in my 401k, I'm paying my 65-year-old self so that person has money at that age, right?
Right.
But you also need to make sure that you tell that person that it's all going to be taxable if you invest it all in your 401k or your IRA, any kind of a tax qualified account that's not a Roth, and we'll get into that. Yeah. It's all going to be taxed in the future. So you're just kicking the can down the road. It's multiplying, compounding, and you're going to owe taxes potentially at a higher tax bracket, maybe not. But for most of us, we will. Higher tax bracket, more money for the future.
And just to add on to that quickly is, for a lot of those folks that are retiring now, it's all they had available because 401ks came out in the late 70s.
Yep.
Roth only came out in the late 90s, and early on, I think people weren't really fully understanding what it was.
Sure.
So for a lot of the folks, that's all they had to save into. And it just, I mean, it is what it is. So now they're kind of kicking themselves a bit, wishing they had some of those things that younger folks or their kids might have in their plans now.
But I think it's important to also point out that when these accounts were created, we were all told that this was a really good thing for us because supposedly you put the money in today, you get a tax break today, then when you are in retirement and you go to pull that money out, we were supposed to be in a lower tax bracket, but that's not what's happening for folks these days, right?
Well, and I would say, they told us, well, who is they? And we all know who they was, told us to be a good thing. Well, remember, the government, they telling us that, I would raise a red flag. But, you could argue it is somewhat of a myth, as not in every case, but in many instances, once we enter retirement, we assume our tax rates are going to be lower. Some cases they might be. But I always say this, it's like, most of us would agree tax rates are going to go up in the future. How can they not? So say someone that's going to be pulling money from these accounts in 5 years, 10 years, 15 years, we don't know what that rate's going to be. It's a moving target. So knowing that, hey, we've deferred these taxes all these years, we always joke, we're kind of in business with the government, with the 401k, and their cut, what percentage of it is theirs is dictated by them, and they can tell us. So that's the part that makes me a bit cautious as an advisor when we're talking to folks.
Yeah, I mean, one way to remember that, what he just said, is imagine you're going to go into business with someone, and that someone says, I'm going to be your partner, and we're going to go into business today, but in the contract, I'm not going to tell you what percentage is mine, and I'm not going to tell you when you have to pay me. But that's kind of what the government says is, we're a partner in your 401k, we're going to let you defer the taxes. but we're not going to tell you what percentage is ours, and we're not going to tell you when you have to pay us. Because we could come back and say, we want you to pay us at 68, 71. Right now it's 73. It's going to move to 75 in 2033. But they get to dictate when you have to pay them, whether you want the money or not. And this is one of the challenges with a lot of people with pensions, real estate, other income streams, is you get to 73, 75, you don't need the money. The government says,
too bad.
We're your partner, and we want you to pay us.
We don't need the money, but they do. Uncle Sam needs it.
Yes, and they've delayed that required minimum distribution age, and everyone was like, oh, wasn't that nice of them? No, they did that because they knew that the money would continue to grow, which means they're going to get a bigger cut of it, right?
Yeah, so, a higher percentage.
Exactly, So we talked about required minimum distributions. Also, taxation of Social Security. That's another area that folks often aren't prepared for.
No, and a lot of the times people think that, well, I've been paying taxes on, portions of my paycheck pulled out for years paying into Social Security. A lot of folks assume that once they get into retirement, as you were just referencing, it's going to be tax-free. Well, there's this archaic number they've been using as, let's give it a quick example. In most instances, 85% of your Social Security will be taxed. And let's just say you're married, filing taxes jointly. If your total income is over $44,000 a year, which is a pretty low number in California, 85% of your Social Security will be taxed, and of that $44,000, half of your Social Security counts towards that.
Yes.
So what if you're getting $30,000, $40,000 in Social Security benefits? That's already half of that 44. Then you got a pension or other income. You're gonna surpass that. So it's like a insult to injury. Hey, you're gonna get Social Security. You paid into it, and surprise, you're gonna be paying taxes on it.
Yeah, and it's not 85% tax. It's 85% of the income.
Taxes
will get taxed at whatever bracket it falls into.
Correct. No, that's an important distinction. One last area of taxation that we have to account for is investment income. And we know a lot of our viewers, as you mentioned, have different types of investments happening. So talk about what they need to think about from a standpoint of once they hit retirement. You've got your Social Security being taxed, you've got required minimum distributions. What about investment income?
Yeah, I mean, it all plays together, and it all gets taxed at different rates. You know, the investment income, if it's short-term, you're going to get taxed at short-term tax rates, which is regular income, ordinary income tax rates, which could be 24, 22, 38, whatever it might be, wherever you fall, plus state income tax, which in California, the higher your income is, there's no long-term gains in California. It's all ordinary income. So, you could be getting taxed, let's say in the 32% bracket plus 9.5 state. You're at 41.5% now if you're in a high income bracket in retirement. So when you're working, it's really important to know. And by the way, you can look at what your situation is. If you go to bwgtaxbill.com right now, click on that, fill out the information, and you will literally instantly get a report sent to you of what your tax bill looks like. It will also come to us. We can call you later, check in, see what questions you have, and help you move forward with that. But it's important to understand this because, again, in California, long-term capital gains, if you hold an equity stock for over 1 year outside of an IRA, then it's going to be taxed at long-term capital gains rates, which, depending on your income, will be either 15 or 20% usually.
On a federal level.
On a federal level, plus state, which will always be at your state tax level. There's no long-term gains. So if you buy a stock, it goes up 30%, and you hold it 6 months and you sell it, you're going to be taxed at whatever your tax rate is, both state and federal. Remember that. It's not what you make, it's what you keep.
Yeah, for sure. Well, clearly you guys have set up a really good case for why folks need to be thinking about detaxing their retirements. I know we're going to talk more about this awesome resource you've created when we come back, but this is something that can be discussed when folks book an opportunity to come in and have their financial compass review with you, right?
Exactly, and it's one of those things, taxes obviously come up a lot. It's a big concern, but it's not the only concern when it comes to people thinking about their financial future. There's other instances like, how much legacy planning, investment management in terms of, am I taking too much risk, not enough? I've got this old account, I'm inheriting this money. All these things that we need to discuss when it comes to what we call financial compass review. So if it's not just taxes, or maybe just taxes are the concern, click the QR code and go to our website, call this number, and we can set up a time to have a conversation and find out what are your concerns and ways to potentially address them.
Wonderful. Scott, Chris, thank you so much. To our viewers at home, that number to call to schedule your complimentary financial compass review is there on the bottom of your screen, 888-970-4685. Or if you'd rather connect online, just pull out your smartphone. You can open up the camera app, Point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Bulman Wealth Group will reach out to connect with you to schedule your complimentary review that way as well. Don't go anywhere. We've got a lot more to cover on today's episode of how to detax your retirement, including some solutions for you right after this.
I became a financial advisor coming out of the tough times of the tech bubble in the late 90s, early 2000s. Moved to California, uprooted my life, changed everything, and then 9/11 happened the first week in this industry. I was prepared already to help people from tough times coming out of the tech bubble, but what we didn't expect is there were 3 years in a row when I started of the market dropping. That really impacted my whole career. It crafted and created how we manage money. We don't want our clients to ever lose like that, and so everything we do is built on protection. The goal of our practice and the people that we meet with is to remove the fear and uncertainty that we all face, and it goes back to those first years in the market.
I was a sportscaster on television. I grew up in Flint, Michigan. In TV, you bounce around, and went to Mississippi and worked at the NBC station there and covered, college football's big, NFL's big, all that stuff. And a guy I knew relatively well in a different state decided to get out of TV, and in this opportunity I always enjoyed finance and money, and it seemed really exciting. I like to communicate to folks and feel like I can communicate well. It was such a fresh, kind of different career than what I was used to that it was exciting.
We go into every meeting with no place to get. We're there to meet with you, to discover your needs, find out where you are at that point, and how we can help you build and craft that plan for the future.
Welcome back to Your Financial Compass. I'm your host, Kristen Oakley, here with both Chris and Scott from Bulman Wealth Group. And today we are talking all about how to detax your retirement. Yes, you heard that correctly if you're just joining us. Similarly to wanting to detox our lives from harmful substances, we want to remove the taxes from your retirement. And you guys did such a great job in the first segment of today's show, really setting up why it is that a lot of folks are headed into retirement with a tax hangover and have no idea. I want to go back and share this important resource that you have created, which is the Retirement Tax Bill Calculator. And we're going to put this site up for you here on the screen. It is bwgtaxbill.com. You can go to that website or click on this QR code. It will take you directly there. And we want to walk you through what this process is going to do. Again, this is a completely complimentary and free resource. You can do it even now as we walk you through it on today's show. So guys, take it away. Explain to folks what they're going to see when they visit the site.
Well, I'll explain how they enter the information, and Chris, if he's up for it, can tell us what happens.
Oh, I know he's ready.
I'm not that old. I can
He
still
was just
explain
telling us in commercial he's cold, so he might need a blanket. So anyhow, if taxes are a concern, which they probably are, or a nuisance, or both, you can go to this website. Well, not my name, but BWG Tax Bill. You go there and you enter some basic information, your name, email, your age.
And we actually have a slide. Let's go ahead and put that up.
Oh yeah, we can pull the slide up. You've seen enough of my face.
There we go.
Email, current age, how much you currently have in IRA, traditional 401k.
Any tax deferred accounts,
Pretty much, yeah, correct.
Yeah.
Any tax deferred accounts, what you think your tax rate or tax rates might be in regards to state and federal. And then finally, what kind of rate of return, say, 5, 6, 7, 8, 10%, whatever you want to put. You enter that information, and then it'll kick out some numbers there as we see kind of the government's plan. If you don't change anything and just continue along and start taking your required minimum distributions in the future, after more years of growth, depending on your age, it's showing that might be your tax bill, that, holy cow, almost $2 million.
Yep.
Flip side, it shows your strategic plan if we potentially make some changes in Roth conversions and things of that nature, which we'll discuss in a second. It's showing the pretty big disparity. So that's the basic information it sends us, but then it'll send something to your email.
Yeah, so you're gonna get this full report in your email. I think it's about a 4-page report or so, and it's gonna give you the information how to decipher it. But also, we're there for you to answer any questions. It's going to show you, one of the things you have to keep in mind is if you have an 8% return, you defer the income for 20 years, and you're in 25% rough tax bracket, state and federal, the numbers are going to be almost the same if you if you do a Roth conversion or if you don't. But what we need to be aware of is most of us think taxes are going to go up in the future. So if we can get taxes, in other words, if you have $1 million and if you were to convert it all now, you're going to owe, let's say, $250,000 in taxes. You'll have a $750,000 tax-free investment that will grow forever, tax-free.
Yeah.
And there are other benefits that come with that as well. But if you leave the $1 million in there, it's going to grow faster because you have more money in there, but you're going to owe more taxes later.
Right.
So all things being equal, it will be equal in the end, except if taxes go up. And this is where it really begins to kill people in the end. When taxes go up, it can really impact you, number one. Number two, Scott sees this, I see this all the time. A lot of our clients, whether they're from the Bay Area, Southern California, Sacramento area, they get to this point in their late 60s, 70s, they built up these big plans, but guess what? Their house is paid off, cars are paid off, the kids are out of the house,
Right.
they don't spend as much money as they used to. They don't need all that, and some of them live just on Social Security and then whatever they have in maybe a pension or real estate or some other outside investments. They never need that 401k that they were bashed all these years to invest in. But then the government says you have to take income. I've seen people go from maybe $80,000 a year income to $200,000 of income just like that because of RMDs.
Wow.
Tax bracket goes up, taxes go up, everything changes, and they're forced to take it out, pay taxes. We have one client that has to take out, I think we send $50,000 a month, every month.
Wow.
Just to convert it, pay the taxes, and then put the money back in.
Right.
I mean, it's really quite maddening if you get to that point.
Yeah, for sure. No, such wise things to point out. I want to go ahead and put that final slide back up again and even just show you these numbers because, again, this is going to be important for you when you put your information in. Of course, you can play around, as we said, with that assumed tax liability as well as with the assumed growth rate. But let's look at this, guys, because I think this is jaw-dropping for a lot of people. This person, it was $1 million, right? $1 million in tax-deferred accounts, 24% tax liability, assumed growth rate of 7%. The difference is so staggering. On the left there, if they do nothing, the government's tax plan for them is having them pay almost $2 million over the rest of their life in taxes. Versus if they were to enact some of these tax saving strategies, look how much less that they're going to pay there on the right-hand side. Only $240,000. Let me ask you this. Do you have people who look at these numbers side by side and are just floored at the difference?
Yeah, so I'm floored now looking at it too, but it's not so much to scare you like, oh my gosh, what have you done wrong? It's really to, make people aware.
Sure.
But also to be a catalyst to like, okay, now say I'm 60 years old and RMDs aren't going to start for 15 years. What can I start to do now? Because again, it always comes back to planning, especially when it...
How can I be proactive?
Correct.
Yeah.
Proactive. There's really two ways to treat taxes. Many of us are reactive for years and years and years. How can we be proactive with it? Especially as Chris was saying, many of us assume tax rates are going up. If we see this giant tax disparity in terms of taking action now and looking into converting or waiting, the numbers tell the story themselves. There's other nuance to it, but we want it just to be you don't have to figure it out on your own. That can be a reason why, you call in, I schedule time to talk. It's just to be a conversation starter, to be like, sometimes you need a tax slap across the face to wake you up. And I mean, sometimes that's what's warranted.
Yeah.
And there's so many different nuances. We're just talking about IRAs and qualified money here, but there's also taxable investments. There's so many different ways, there's pension investments, there's real estate investments. Can you take money just from the real estate without paying taxes? We can talk about all those questions you have, and I think it's important. But the first thing, log into bwgtaxbill.com, click on the QR code, and go in, fill out the form, or give us a call, and we'll talk to you. We'll schedule a time to meet and help you in whatever way we can with no pressure, no sales tactics. It's all about educating and moving you forward down your road to retirement.
Wonderful. Well, Chris Scott, thank you so much. And I'm confident that once you visit bwgtaxbill.com, again, you can go to that site, you can click on that QR code, and you enter in your own information. It's a completely free resource, but once you see those numbers side by side, once you see the difference between the government's tax plan for you if you do nothing versus how much less you could pay in tax if you enact some of these tax saving strategies that we're talking about on today's show, you will definitely want to reach out and schedule that complimentary financial compass review. So to do so, simply call the number on the bottom of your screen, 888-970-4685, or you're welcome to scan that QR code and that will get you connected as well. When we come back, we're going to be sharing some real life examples of what it looks like to detax your retirement. Stay with us.
The team at Bulman Wealth Group is exceptional, from our advisor team to our service team, which is, I think, second to none. But it all revolves around the idea that our clients are vitally important.
One of the ways I feel like we differentiate ourselves is we want a relationship with our clients. And I really learned that from Chris. Is there's so many dollars and cents and all this information to know, but at the end of the day, it's got to be a trust and a like, because we're partnering with somebody. So I want them to think a trip to see me is not a trip to the DMV or to the dentist, but it's just being able to share in the good times and be available to be a resource in the bad times too.
Our clients are our friends. I really view them as part of our family because we go through some pretty significant life events. So it's really being a partner with our clients through all those life events and through the life journey. Did you know the IRS is your silent partner in retirement? It's true. If you have a traditional 401k, IRA, pension, or similar retirement accounts, they're all tax targets. But how much? To find out your potential tax liability, get our easy-to-use tax calculator. Just scan the QR code or go to bulmantaxbill.com.
Welcome back to Your Financial Compass. I'm Kristen Oakley here with Chris and Scott from Bulman Wealth Group, and today we've been discussing how to detax your retirement. Again, we encourage you to reach out if you want to see what those numbers would look like for yourself. We are offering this retirement tax bill calculator for you to use. You can even do it right now during the show. All you have to do is visit bwgtaxbill.com or click on that QR code, and you'll be able to enter in some basic information and see what those numbers could look like for you. And we're playing on this whole theme of detox, right? Usually you have a detox plan. You guys enact detax plans for your clients. So I'd love for you to share some of the strategies that you're able to utilize to help people do that.
One that comes up that has flown under the radar, I feel like, is what's called the acronym is a QCD, a Qualified Charitable Distribution. And as Chris said earlier in the show, a lot of times our clients get to the point of having to take those RMDs, required minimum distributions, and they don't need the money. It's just extra money they have to pay taxes on. Some will turn around and reinvest it. But one thing you can do is if you're over 70 and a half, you could essentially take money from an IRA, traditional IRA, and gift it to a charity. It has to be a real charity. It can't be like my son's charity and he's the actual charitable benefactor.
Right.
But a real 501c3 or whatever it's called, you can give up to $100,000 a year per individual, and it doesn't count against your taxes. So it's a way to be kind of obviously charitable giving, but also it helps you with taxes. So the QCD is one that seems to be picking up steam as we're talking with folks, but a lot of people aren't even aware of it.
Right.
So definitely worth looking into.
I always appreciate that you all talk about this, because especially for folks who don't need their RMDs to live off of, who are charitably inclined, that can be a great way because it also satisfies that required minimum distribution. It's a win-win, and it's a win for the charity for sure, right?
Yeah, absolutely. And there are other, let's say you're a high income earner. So sometimes if your income's high now, you may not want to, within your 401k, you may not want to invest in the Roth portion, because you could be, let's say you're making $500,000, $700,000 per year. And when you're in retirement, it's probably not going to be that high, but it could be, which is why you need a financial plan. But let's say that based on everything we know, it wasn't going to be. So maybe it's worth investing in the qualified plan now, getting that tax write-off, because at $500,000 or $700,000 a year, maybe you're going to retire early. Maybe you're thinking about retiring at age 55 or 60. Now we've got a big window from 55, 60 up to age 75, where you can take that income, convert it to Roth at a much lower tax bracket. Maybe we do $50,000 or $100,000 a year of conversions, but now we've got 15, 20 years to do those conversions.
Yes.
So sometimes it's worth taking the tax break up front versus some people just say, invest all your money into Roth only because it's tax-free forever, get the taxes out of the way. That's sometimes true, but not if you're in the highest tax bracket now and won't be soon.
Sure.
So there's a lot of nuances that go into this. I don't want to make it like it's a blanket statement.
For sure.
But that's one of the things to think about, especially we have a lot, we're on in California, we have a lot of high income earners. So we want to make sure that people understand there's different times in your life where you want to take the tax deduction up front,
right,
and different times where you want to go ahead and pay the taxes and invest in a Roth.
Sure. And to that point, because a lot of high income earners have this conception of, oh, I can't do a Roth because there are income limits to Roth contributions, but that's not the case for Roth conversions, right? So that's an important thing to clear up as well.
Oh yeah, no, the Roth conversion, a conversion and a contribution are two different things. So conversion, in most cases, will help the person converting. You hate to help Uncle Sam, but you're helping them by, they want you to do the conversion and they want you to convert as much as you can because you have to realize it as income. So that's part of the equation. But another thing I want to bring up too is like, sometimes people will ask, well, why would I need to convert? I'd rather, I've got $1 million, what have you. Another thing as kind of a secondary benefit is beneficiaries in terms of legacies. Like say you've got two kids and, in most instances you're going to pass away when they're probably in their prime income earning years. If you leave, say you've got two kids, you've got $1 million in IRA money and you leave that to them, they each have a 10-year window where they need to liquidate that account and pay all the taxes. So if their kid's making $250,000 a year and then they have another $500,000 they have to convert over the next 10 years, it's a nice gift from you, but they're giving up. I mean, that could hop them into another tax bracket. Otherwise, if you leave them in a Roth account, obviously all the taxes have been accounted for. So it's another factor to consider too, is just how does this chunk of money affect your beneficiaries, your legacy, what have you?
Yes.
Yeah, and this is a perfect reason why you want to work with a financial planner, because what he's talking about is the stretch IRA, which is not there anymore.
Right.
So if you were an expert on the stretch IRA, my IRA can go to my kids, then the grandkids, then the great-grandkids. They got rid of that in, I think, 2020. Now they have 10 years to deplete the whole thing. So if you have $1 million and you have two kids, they have to at least take about $50,000 a year each per year taxed at, if they're in the highest tax bracket. That's a lot of taxes going on. However, if you're in a lower tax bracket and we're able to convert that in your lifetime, then they inherit the Roth IRA. No taxes, they can hold it as long as they want.
Yes. One of the takeaways I'm thinking as we're wrapping up today's show is this is not something anyone should try to be doing on their own without some professional guidance and help, because there's inadvertently all these ways it can go wrong if not done correctly, right?
We always say we do this full-time, you do it part-time. It's okay, you don't have to know all the rules. That's part of, we can't come and do your job, and it's okay if you don't know all the intricacies, what have you, and nuances of this. So if this sounds like you have questions, you want a second opinion, call the number below, click the QR code, scan it, and we can have a conversation.
Wonderful. Chris Scott, thank you so much. Thank you for being here. We look forward to being back with you next time here on Your Financial Compass.